All right, all right. What is going on, guys? We're gonna share the link here. Actually, see how do we do that? Give us one sec. We are live. We're gonna do a land investing Q&A, and it is gonna be a good one. So let's get this queued up. I'm calling in from Hawaii. I'm in Oahu, down in Waikiki right now. Just flew in yesterday. Absolutely love it. Get out of the cold inside Vegas. We've been getting dumped on with snow the last few days. It's been pretty wild, actually, the last week out there. Sorry, I'm just getting an email sent out to everyone to let them know to come and join. So yeah, what we're going to be doing here is essentially like a land investing AMA, Q&A, whatever you want to call it. And so any questions that you guys have, you can throw them in the chat. What we're going to do here is we've actually got a question box that we already got some questions that I'm going to share here in the chat. So if any of y'all have questions, you can pop them in here or pop them into the chat, either or. So we're going to get some of these questions queued up here. And let me just do a little bit of housekeeping. For anyone that's new here, my name is Sumner Healey. I run a few different businesses, one of them being the landpioneer.com. That's our land investing business. Second is landinvestor.co, where we help folks grow, scale, and really, in some cases, even start land investing businesses. If you guys want to learn more about that, you can schedule a call with my team at that link down below. To do a free land investing strategy calls where we go and build you out a land investing roadmap. We say, cool, this is where you're at. This is where you want to go. We reverse engineer the levers that you have to pull or the inputs that you have to put forth in your business to get the outputs that you're looking to have, right? And the truth is, this business is really, really predictable. And so if you know the right levers to pull and you know how much you got to input, it's pretty easy to figure out what you're going to get on the back end. Anyways, let's dive into the questions here. So we've got a handful of questions inside the question box. And as you guys are on this call, if you want to submit any questions, feel free to do so inside the chat. So the first one comes from Cleo Wright. To be honest, I'm not sure I really understand this question, Cleo. You say, where do I begin to look for the land? If you guys are going to ask questions, make sure they're specific. This is a tough question to answer because it's incredibly broad. I'm going to take a guess here and assume that what Cleo is asking is, where do I go and A, source leads for sellers to find land, or B, where do I find the right markets to work in, right? So first and foremost, we've got a bunch of market selection videos on the channel. You guys, if you've seen me talk about this before, you know this is the backbone, this is the pillar of everything that we do, right? It's really easy to go and thank you. I appreciate that. That's very kind of you. What up, Bill? Good to see you, brother. So what I will say, right, is it's incredibly easy to go and buy land. And when I first got into this business, that's how I ran my business. Send out some mail to fill in the blank, whatever county, whatever market, throw a dart on the board, go buy land there. The trouble was I could buy land in pretty much any market, but the disposition side was really, really difficult, right? Selling the property was really difficult. This is where most land investors live. All of their efforts go to disposing of the property, selling the property, and they don't really do much critical thinking on the front end for acquisition. So to answer your question, Cleo, the way we go about the land business is really focusing on market selection, finding markets that have demand. We look at sell-through rates. So the ratio of how much supply is there and how much land is turning over on a 1 month, 3 month, 6 month basis. And we say, okay, cool. If it meets our kind of our criteria, we'll move forward with it. There's a few other variables, of course, but from a high level, that's it. So Cleo, if you go to the YouTube channel, you see we've got a bunch of market selection videos that you can watch. That's top of the funnel, right? Go find a market. The next step is, as you guys know, we use direct mail as kind of the backbone of our business to go and source seller leads. And then on top of that, we'll use cold texting as well once you start to scale up. So Cleo, I would start there. I could be totally misinterpreting your question, but I don't really know where do I begin to look for the land. Clifford, right. I also don't really understand your question. He says, what states besides Texas make it easier time 2 months expense, 5K to 30K to break up 100 acres into 10-acre lots? Oklahoma, North Carolina. Who? Thanks. Yeah, Clifford, I don't really understand this one. There's like two different questions here. So the first question, I have no idea what that means. The easier time, 2 months expense. The second question, so what he's asking or what I'm inferring here is, all right, cool. I've got, as you guys know, I'm working on Subdivides in Texas. And the reason that we've been doing that is because there's a lot of exemptions that we can use, right? It makes the process pretty darn straightforward. Like if you wanted to do a subdivision here in California, there are so many hoops you have to jump through, and like the cost just to get it reviewed and the timelines and the red tape, it's crazy. And at the end of the day, it's almost like, well, the project's not really worth all of the investment on the front end, both in terms of time and resources, right? One thing you guys will always hear me talk about is the kind of balance of your inputs to your outputs. I'm constantly thinking like that in this business, right? How much am I investing in terms of work or capital on the front end? What am I going to get on the back end? A place like California, your inputs to your outputs for a subdivide just don't make sense. Clifford, the only place I've been focusing on currently has been Texas, right? A lot of other states that you can do it in, though. Oklahoma is a popular one for folks that kind of want to get away and do simpler subdivisions with a bunch of exemptions. I'm not too familiar with carving up land in North Carolina. There's obviously a lot of subdivisions out there. I don't really know anyone doing it at scale. Arizona, you can get away with some pretty simple 4-lot splits. Colorado, in some spots, you can get away with a 4-lot split. So, for example, in Texas, the main exemption that you'll see is 10 acres and above. So if you've got 1,000-acre property, you could chop it up into a bunch of 10-acre lots. What you'll see in a lot of other states like Colorado and Arizona is it's not about the size per se. It's more about the number of lots. That's a really common exemption. It's usually a 4-lot exemption. So if you have a 40-acre, you can break it up into 4 10-acre lots. We've got a project out in Colorado, a deal that we just got. It's an 80-acre, and we're breaking up into 4 20-acre lots. Rob, what kind of uses do you consider when thinking about keeping a deal? I've never kept a deal. So yeah, I mean, I think I've been close. I've thought about like, man, maybe I could build an Airbnb on this or do something cool with it. I've had a few properties that were like kind of glamping style, like they had the raw material for that. And that's something I've always been fascinated by, right? We had a bunch of properties in Joshua Tree that were like, during the heyday of crazy Airbnb bubble craziness out there, I was like, I kind of want to keep these. And then we had this wild property out in Arizona. It's actually in Mojave County, but it's in a really nice spot in Mojave County. And for sure, Bridget, yeah, thanks for stopping by. This will be live, so you can come back and watch it. But out in Mojave County, this beautiful property tucked up in the hills, right on the border of Mojave and Yavapai. And it had like this 800 square foot cabin. It was kind of rough, but it was permitted. It had a creek on it. So something like that. I was like, yeah, you know what? I might keep that maybe for personal use, but really kind of more leaning towards like an Airbnb build out. But no, yeah, I haven't kept anything. That's an easy one. That's wild. You haven't kept any. Do you own any property? So I guess that's kind of a lie. I did keep one property. So I kept one property out in Texas that I actually sold last year. It was a long story. It was a piece of land that had a trailer on it. We ended up renting the trailer out for like $800 a month. I bought the property for $900. So, we're collecting close to 10 grand about 10 grand a year off of an $900 property. It was a wild deal. Ended up selling that though. We had some issues with the neighbors and people dumping septic into people's other properties. So I've never really kept anything long-term, right? Like when I look at this business, when I look at any business, right? Like the framework that I use is specialization. I think a lot of people want to wear different hats and do a little bit of everything. Like this is my land flipping business. And as the name implies, I flip land. It's highly transactional. I do cash sales. I do owner finance sales. Now, if I want to go and take that capital and redeploy in other buy and hold assets, I think it's a different story, but that's a whole different business to me, right? I don't like kind of cross mingling and doing a little bit of everything. Something that I'm really focused on this year, though, is buy and hold assets, right? Like, yeah, Bill, I've heard of Hip Camp, actually. So I'm in Hawaii right now. I stayed in a Hip Camp out here last year, $80 a night for me to sleep in someone's driveway. Pretty wild. And actually one of my first LIA members, like 2.5 years ago, his first property he bought out just north of Joshua Tree. So in Southern California, like east of LA, he bought this crappy little lot on Landwatch. It was like a $4,000 property. It was a little desert square, 2-acre lot. And he was renting it out on Hip Camp, making like $500 to like $1,500 a month on Hip Camp, which is pretty crazy. So I've stayed on Hip Camps. I think it's an interesting business model, but again, I haven't held anything for Hip Camp. But to go back to what I was saying, like one of the focuses for me this year is buy and hold rental properties, right? And they don't have to be single family homes. Like I'm not dogmatic. It could be self-storage, anything, right? I'm just really focused on how do I bring down my taxes because this is such an active income business. But yeah, and Robert, like not to say that I wouldn't make an exception to this rule, but I think in most situations, I'm looking at everything from the lens of like, In this business, it's transactional. I flip. This is my cash flow business, and then I redeploy that cash flow into other assets. So yeah, that's kind of the name of the game for me there. If you guys have any more questions, be sure to pop them in the chat. I'm going to work through another question that we got here. All right, so Alec has got a couple different questions. Could you hit on some double close specifics? So if you guys are unfamiliar with double closing, pretty simple strategy, right? Like it's people think it's similar to signing a contract. It's not really the same as signing a contract, but it kind of plays out in a similar fashion. Yeah, Rob, if you can connect me with some creative rentals, hit me up. I'm definitely keen on that. So assigning a contract, right? You've got a right to a contract. You're assigning that contract to someone else. It's like the wholesaling land model or wholesaling anything model. Double closing is a little bit different. You're going to have like an option agreement, for example. You put an earnest money deposit down that's typically non-refundable to the seller. And then for whatever duration of time, could be 3 months, could be 6 months, could be 12 years, who knows? You've got a right to go and market that property. And what you're doing is you've got the seller, you've got you, and you've got a new buyer. So there's 3 parties in a transaction, and you're just kind of linking them up. In some states, you'll have like what's called pass-through funding. So the new buyer's funding can go and cover their original purchase price to the original seller. That's great. Like in Texas, if I get a deal under contract for 50 grand and I get a buyer for 100 grand, not only am I going to make that spread, but that 50 out of the 100 will go and pay the seller, and I don't have to have any cash come out of pocket. Now in a place like California, that's not true, right? So if I find that same situation, 50 to 100, there's 3 parties, I'm in the middle, I'm going to have to go and pay the original owner first. So pay them their 50. I'll be out of that 50 grand for, a week or so. And then I'll have to go, once I get the capital, the 100 from the new buyer, obviously I'll be made whole in that transaction. So let's talk about Alex's questions here. So typical buy box is a percentage of market value. All right, guys, this is my least favorite question in the world. And Alex, this is not a knock on you. Whoever talks about percentages of market value for a buy box it doesn't understand the business, right? It's so contextual. It's so contextual. And Alec, again, this is not a knock on you, but I think a lot of people out there, educators in the space or what have you, say we buy at 40 to 50%, we buy at 20 to 30, whatever the percentage is. That's baloney. It's contextual. It's different in every single market, right? Now, what I will say, I think a better framework to have is not, hey, I use this offer percentage, but I have a bare minimum on how much I'm going to net on a double close. That's a better metric, right? Because I might do, for example, Mayor. If you guys watched Mayor's interview, Mayor's an awesome guy, just a double closing beast, right? Came in year 1 of this business and just double closed dozens and dozens and dozens of deals, multiple 6 figures, never put any money into a single deal. Like he's just built a double closing business. And his rule, which I think is wise, is, hey, I will only do a double close that bare minimum nets me 20 grand. In some cases, that means he's doing a deal he's getting for 200 grand and selling for 220. And then in some cases, doing a deal that he's getting for 10 and selling for 30, right? So what's beautiful about the double close strategy is percentages go out the window. It just doesn't matter anymore, right? And so I never do marketing for double close properties, right? So the way we go about it is everything for us starts with, hey, this is going to be a cash deal. And I think cash deals are superior. Think about it. It's a better experience for the seller. It's the only way we really add a lot of value, right? Because we can come in, take an illiquid asset, price it, right? First off, how do land investors get paid, right? What we do is we go find markets that have demand. We quantify prices for a very difficult asset to quantify what the values are. And we give an illiquid asset the ability to liquidate. That's how we get paid, in my opinion. So when we come to a seller that owns a 20-acre property in bumfreak nowhere, and we say, hey, seller, we'll give you 30 grand. Like, okay, cool. I actually didn't even know really what it was worth. So this guy's giving me a surefire offer, no negotiation, straightforward. And better yet, we'll close in 2 weeks and you'll have cash in your pocket. And better yet, we'll cover all closing costs and all that jazz. That's a big value for the seller, right? And so that is really, in my head, the way I like to do business, because I think we can get a better yield from our marketing in some cases, or not a better yield from our marketing, but we can get better deals because we're adding more value to the seller. Now, so the way we go about it is everything's going to start from that frame. This is going to be our standard. We're going to cash them out. We're going to get the deal in 2 weeks. We're going to go market it. Now, on the flip side, we still are going to present double close offers to leads that are tough to work with. So they're going to start, and the marketing funnel is this is going to be a regular cash sale. They come inbound to us. We start working that lead. And let's say we just can't agree on a price. It's like, cool. Okay, we can flip the script. we'll give you more, but it's our terms, right? There's that old cliche real estate saying, it's like your price, my terms, my price, your terms, that kind of deal. So every seller is going to, in most cases, is going to want cash in their pocket sooner rather than later. Right? That's why they're reaching out to us. Not to say that all land sellers are distressed, but they're usually not wanting to wait years to get paid. They're ideally going to want to get cash in their pocket sooner rather than later. And I just lost my train of thought there. So let's go back to the question. Where was I? Yeah. So again, to go back to it. So the way we position these conversations is we'll present 2 offers, and we don't do it to every single lead. We'll do it to the leads that are curmudgeon. We can't work past next steps, can't get them to the price that we want. And it's a great way to get deals that might have been dead otherwise, and then get them into our ecosystem. But there's still exceptions to that rule. We're not going to double close anything, right? Because when we look at a double close, there's a lot to manage there. You're managing 2 other parties' expectations. That can be really, really tricky, right? And what we find is it's actually not super tricky with the sellers. If you do a good job on the front end educating the seller on what to expect, timelines, the process, and you've given them a healthy earnest money deposit, they're typically fine with it, right? They've had this property that's been sitting for a while. They get cash in their pocket for the earnest money deposit, and then you can go market it for a few months or a few weeks. They typically don't care a whole lot. Where I've seen these deals break down is with buyers. Buyers can be real sticks in the mud when they go and say, wait, you're not on title, or whatever it is, like the realtor alerts them to some issue. That can be really tricky. So the buyer side of things I've noticed can be what's up, Dennis? The buyer side I've noticed can be really difficult to manage expectations appropriately. The other thing is, like, there's some weird workarounds that you have to do, like to get it on the MLS, to find a flat fee MLS provider that will market it for you. Like, you got to find a good title company. So there's a lot of extra legwork that goes into a double close deal. And therefore, we got to make sure that the payoff is worth it. So to go full circle, Alec, it's not an offer percentage. It's a bare minimum of how much we can net on a double close, which I think a good kind of threshold for most folks is about 20K, right? If you're just starting out, you can kind of skinny that down. I think to get your feet wet and to get familiar, you can skinny it down and say, I'll take just about anything to figure it out. That's fine. But as you scale up, I think it's really important to kind of set a threshold, because you're managing the expectations for the owner, managing expectations for the new buyer, managing expectations for title companies, realtors. There's a lot of babysitting, right? Mayor's got a pretty comprehensive strategy in terms of how he like keeps all the sellers nurtured and in the know while they're under contract, and how he's a great negotiator. He's great with people, but how he structures the conversations with real estate agents and title companies. Like, a lot of cases, what he's doing is smooth talking these people to get the deals done. We just don't really have that same issue doing kind of our bread and butter cash acquisitions. How does transactional funding work? So that's Alex's next question as it relates to double closing. So yeah, it depends on the state you're in. Some states you're not going to need that. Some states you will. So let's say that deal here in California that we're referencing, 50K is the price that's getting paid out to the current owner, and we're getting 100K from a new buyer. But let's say we have to wait 5 business days for the kind of the capital, the money to settle, right? So we got to pay the first person, then we got to wait 5 business days, and then we're going to get the 100K from the new buyer. There's a lot of outfits out there, and Greg inside the program, who does the deal funding, they do stuff like this. A lot of outfits out there that say, great, that's pretty much a surefire transaction for them. There's hardly any risk for a deal funder there. And so they'll give you capital, and it might be a couple points, right? You're just going to be like a flat percentage, might be 5 points, whatever it may be. And so that way you can actually get it, even if you're working in a state like California where it is no capital out of your pocket. That's a sweet setup, right? The trouble too that I've seen with double closing is just kind of a word of caution here, is sellers do not respect contracts. I've seen this time and time again. And I don't know if I'm just that maybe it's just like an internal bias that I have, but I'm not one to litigate. Like, maybe if the deal's really worth it, sure, I'd go the extra mile. It's just not really my style. Like I just wouldn't. And so what I find in a lot of cases, not a lot of cases, but here and there, especially with the double closes, I've had it happen with regular deals very, very, like, not very often. But with the double closes, because they're sitting under contract for so long, they're still going to be getting marketed to by other sellers, or other buyers rather. And I've had sellers go and take a new offer because it's better, and they're going to get paid immediately, and just say, yeah, this contract doesn't matter, and I'm not going to chase them down. So that's the one thing that you got to watch out for, right? Like, just because you have a deal under contract doesn't mean it's a surefire thing. With the double closes, like, it's a different game. It's a different business model. And so for me, it's not, it's a tool in the tool belt. It's not the entire model. I think a lot of people get into land investing game or any real estate vertical. It's like, how do I do deals with no money out of pocket, wholesale, double closes, option contracts? That stuff, it does work, and you can definitely build up a nest egg. But I don't know how Mayor does it personally. It's not a business I want to live in entirety. I think it's a tool that we get to exercise when we see fit. And how do you explain the process to the seller? So how do we explain the double close process to sellers? We try not to over explain. I think anytime you're talking about the closing process or next steps with a seller, in my opinion, it's important that they're always in the know, right? So I think a confused mind says no. So like at least let them know the general kind of process of next steps. Hey, when we get after this call, I'm going to send you a contract. Please review the contract. It'll be inside. Now, like let them know what to expect. I see so many land investors just like under explaining the process. But on the flip side, you don't want to go too far and give them every single point about a double closing. So usually the way we structure it is, hey, okay, so let's say we offer them 30, they want 60 for the property. They say the property's worth 90. We're still going to try to negotiate them down. We're not going to just try to give them their price just because we still know we can have a spread there. I'm still going to try to like kind of push and pull. We want to make sure that they feel like they got one over us, right? And like we weren't just a total sucker and took that 60K offer. And then from there, we're going to explain, okay, cool. If we're going to do your price, this is what we're going to do. We're going to pay you today, but it's going to be a non-refundable earnest money deposit. So you're going to get that money today, right? And it's for us, we start at $500. So our kind of boilerplate setup is $500 and a 3-month window to double close. I'm actually going to share with you guys a really interesting double close deal that we're working on after I tell this little quip right here. So yeah, $500, 3 months. That's where we start at. So hey, we just Venmo it to them, like immediately on that call or after the call. We'll just send them the cash instead of sending it to a title company. That'll be non-refundable. But in the interim, if we're going to pay you today, we do need 3 months, whatever it is, to go and do our due diligence, market the property, try to like link up a buyer. And so we are explaining that we are going to go through the process of marketing the property, but we also hit on we need to do due diligence and fill in the blank, and that is true, right? And one of the things that I reference to, because some sellers are like, is this legal? Is this a real thing? How does this work? I'll talk about how this is how all developers do acquisitions, right? They get an option contract on a piece of land. They're going to have it kind of where it's like this step up pattern. So, okay, cool. We'll give you $5,000 today for earnest money. We'll go and do our reviews with the county. If everything checks out, we'll give you another 10 for earnest. And they'll kind of keep on bumping it up in milestones. So I'm like, hey, this is how most development is done out there. It's through an option contract. But I try not to over-explain it. So then if they are like, sure, send me the contract, which most people are. Like when you explain that you're going to get cash in your pocket today and it's non-refundable, whether we perform or not, people are like, okay, that's pretty exciting, right? And then we just send them the contract, and then they go through the contract, and that spells everything out. So I kind of let the contract do a lot of the heavy lifting in terms of like the terms and how we have the right to market it and all that jazz. And it works pretty damn well. And so right now we've got 2 different double closings. My team in January got a little overzealous with the double closing, started getting deals under contract that were not very good. So I had to pay out a couple grand in earnest money deposits for properties that sucked. So something to be mindful of if you have a team doing this on your behalf. The other thing is we have a deal right now. Bridget, what do you mean you just Venmo the earnest money? How does that work with escrow? So when we send it off if we send it, which there's a lot of cases where we don't send it off to a title company, because so far this year, we're kind of 0 for 2, right? The 2 deals that we've done haven't played out. But in the past, we would just send them a check or Venmo them or PayPal them, whatever the kind of the best mode is for them. And then when we send it off to a title company, we just tell them, hey, we had already paid in the earnest money deposit, send it off like it's a normal transaction. Never had any issues with it. And I actually learned this from Mayor. This is kind of the backbone of his full strategy, is like because I think that it turns the seller's mind on and excites them when they get the capital right now and when they can feel the cold hard cash. One thing that's to note though is we do it once a contract's signed, so we're just run off with the money. But usually on the call, like we'll have our team send the contract and they can go through and review it while we're on the call with them and try to get them to sign then and there. Justin, what targeting a market for a mailer do you typically hone down to a specific subdivision by zip code or by lot size, or does it just depend on each particular market? Okay, we'll talk about that in a second, Justin. It's a good question. So yeah, I like to make sure they have some cash in their pocket. And now, Bridget, this is something that's important to note. The vast majority of our double closes thus far, and I've probably done 5 or 6 of these things, have been $500. If it was more, we actually have had a few that were $100. If it's more substantial, like $1,000 and above, 2,000, send it to a title company for sure. Get that in escrow. We've got a subdivide that we're working on in Texas right now, which I'm a little scared to sign the contract. And we'll talk about this deal here in a little bit. Some crazy stuff has come up with it. It's a buy for $950,000. If we can chop, it's 200 acres. We can chop it up into 20, 10-acre lots. Looks like it's worth like $2.5 to $3 million. And there's a $5,000 earnest money deposit. So I'm not Venmoing that or doing anything silly with that. But for these little $500 ones, for sure. Dang, I keep on losing my train of thought here. Well, yeah. So Alec, to go back full circle here, that is how we explain the process to sellers. It's just, walk them through next steps, let them know that they're going to get an earnest money deposit that's non-refundable, whether we perform or not. They get that. They'll get it the same day that they sign. Try to walk them through the contract while you're on the phone with them. If they sign it, send them the money right then and there. And then you're also going to spell out how long it's going to be for. When you do these, do you file? So yeah, Dan, it's a good question. I have never filed a memorandum. I know some people are super gung-ho about it. I think there's a time and a place. If the deal is so good, for sure. Right. I've had some deal partners in the past who want me to file a memorandum for every deal. I think that's overzealous. Or in general, do you file? Yeah. So I don't file any memorandums. I never have. I think, again, there's a time and a place, I'm sure. One, it's just not really how I like to do business. Right. Like it's just, I think there's a time and a place where the deal makes sense to set it off with a memorandum. But I think if you're doing that to every single deal, like if a seller really needs to walk or has a better offer, sometimes I think I'm too tuned in to the abundance of the world, but I'm always like, dude, there's another deal. There's another deal. There's another deal. There's another deal. I don't want to just screw someone over. I don't know. It's just not my style, but I'm sure there's a time and a place where you could do it. There's some land investors that do it for almost every deal. Just not really how I do business. So I never have filed a memorandum, but it's certainly something that you could do. But this is my memorandum, for example. If the deal is so goddamn good, I am closing on it. If the deal is amazing, there is no shot I'm running the risk of double closing it. No shot about it, right? And so that is my quote unquote memorandum, is getting my name on title. So I perform, I pay them, I get on title. So anytime a deal looks like a slam dunk, you bet your bottom that I'm going to go and close that thing as fast as possible. Even if I have no idea how I'm going to come up with the money, I will find a way to make it work. The double closes, a lot of times when we're doing the double closings, it's less so because the seller wants a higher price. It's more because we have our own reservations about the property, right? Something seems materially wrong with it or funky, or the comps are weird. That's when I like to leverage a double close, is when there's too many unknown variables in the deal. And so for deals like that, I'm like, I don't really give a shit if we get on a memorandum or not, to be honest. The deal's so good, I'm just going to close on it. But we've got this interesting double close deal right now. So like I said, we're 0 for 2 for double closes this year. Paid out a couple grand in earnest money deposits. We actually had my first double close deal was an insane deal. It was in North Carolina. It was a buy for 22. I think we sold it at 49 or 55, and we sold it in a couple of days. It was a really cool deal. And that was like accidental. Like I just kind of stumbled into it. And that was a byproduct of just not having very much money. I definitely didn't do it on the up and up. I didn't have the right contract. Had it under contract though for a purchase agreement, had a few months to close on it, started marketing it on Lands of America in the background, and it ended up flying off the shelves. Bridget, last question about double closing is, what do those touch points with the seller look like while you're waiting for the buyer to come in? Yeah, that's a great question. So I'm definitely not the resident expert on this, because at any given time I have at most 1 or 2 that I'm like working with. And so it's pretty easy to manage this. What Mayor does though, so at any given time, he could have a few dozen of these like double close candidates that are under contract, and he's marketing them. He has his team send out a weekly text. And essentially the weekly text is like, hey, no news is good news, right? Like nothing's changed here. We're still working to sell it. We should have the money to you soon. I think that's really smart. Even if you don't have like a real bona fide update, just touching base with them goes a long ways. So I would do something like that, right? And you can just set it up on an automated cadence, or just have your team send it out. Could be a text, could be an email. Doesn't have to be over the top, but just touch base with them weekly. My sister and I are planning to start the land business as partners. Can the two of us alone do $1 million profit per year? Very unlikely that you two can do $1 million. I mean, it's possible. Anything's possible, right? There's always exceptions to every rule in the land business. Would be very unlikely. So the hiring hierarchy or roadmap, and we go over this ad nauseum inside the LIA program, is you start off with a generalist VA. You move up to an acquisition manager, you bring on an intake manager, you get a dispositions manager. At that point, that's about a 7-figure land business if you're doing enough mail, enough marketing. Now, RB, with that said, there are some people out there that have really low volume businesses. Maybe they do 3 or 4 subdivides a year and they will net $1 million. But if you are kind of mimicking the LIA strategy, which is more around mid-market, we're lowish volume, higher ticket. But my business last year, we did 110 deals. Like most people inside our program are going to do 20 to 100 deals a year. That's going to be almost impossible not impossible, but very difficult to run as a 2-man show. The other thing is your life is going to stop. Like your lifestyle will be horrible, right? And at the end of the day, I've talked to, I don't know, probably 100 plus land investors in the last 3 months. The core thing that I see with the land investing community is that we're shooting for a lifestyle, right? Like one of the beauties is I'm here in Oahu hanging out for the week, right? And the land business gives you that flexibility. Because in the grand scheme of things, even if you're doing a higher volume land business, like we're relatively high volume, it's still a pretty low friction business. Like I have some friends that run e-commerce businesses that sell 2,000 widgets a month, and they have to think about supply chain issues. And like, there's a lot of the stuff that goes into it. We're pretty low friction, low intensity. It's a pretty damn straightforward business. But RB, if you're running $1 million net business with 2 people, you guys will be grinding. And it's very unlikely, even if you're grinding, that you'll be able to pull it off. So no, you certainly need a team. I would be curious what your trepidation is to have a team. Like this is the lowest hanging fruit for land investors, right? Most land investors are first-time entrepreneurs and they have no experience around hiring. No one teaches us about this stuff in our day-to-day existence, right? As we're growing up as kids, as we get into the workforce, no one shows us the ropes of hiring and leading. It is the single most important skill set I think you can develop as an entrepreneur, right? An entrepreneur, in my opinion, we see opportunities, we build out kind of a roadmap or a game plan of how to extract value from that opportunity, and then we assemble a team around it. Right. And so the land business is a labor play. When we look at business, there's automation, delegation, elimination. For most land investors that join the LIA program, it starts with eliminating a bunch of useless stuff that they're unfortunately wasting their time on. Then it's delegating, so building a team around them. And there's very little automation in this business. There's just not much automating we can do here. What do you think we could profit per year, just the 2 of us? So first and foremost, if it's your first year, like what we see for solo operators in the LIA program, first year, if they're grinding, going hard, you can make upwards of $400K a year. But even then, they usually will have 1 or 2 VAs. So first year, let's just be conservative, probably $250,000, maybe $300K. And then as you guys scale up, it depends again on what kind of business you're going after in the land space. So if you want to specify in the chat what your quote unquote volume or business model would be, and I could give you a little more insight, but I think $500,000 to $700K is pretty doable, maybe $600K, somewhere in that range. But the caveat is it depends on what kind of deals you're going after. If you're going the big value add subdivide route, you could certainly net $1 million. You can net $1 million on a deal, but the barrier to entry is so much higher for that most folks that are starting out, way too much of an undertaking, and there's too much risk that you're exposing yourself to because these deals get really big. When you're first starting out, it's natural that you're going to make mistakes, but when you're flipping a $10,000, $20,000 property, the worst case scenario, maybe you lose a few grand if the deal really goes sideways, right? That's very, very riskless in the grand scheme of things, and you're going to have enough of the rest of the deals that are going to kind of offset any potential losses. You can have one subdivide that ruins you, like bankrupts you flat out, right? We're talking about millions of dollars at stake here. You're talking about a lot of red tape with counties for the improvements. I'm going to talk to you guys about the subdivide that we're working on and kind of the nightmare situation that we got ourselves in. So yeah, I'd say probably max 600K, but RB, I'd be curious why you don't want to have a team, right? I think it's in your best interest to build a team because at the end of the day, I think lifestyle is paramount over just income. Bridget, and don't forget okay, Dennis, do you have a due diligence checklist once you go under contract? Yeah, so I mean, yes, it's very, very general though. Like when we look at due diligence, one, we're going to let the title company do a lot of the heavy lifting. So like liens, any of that weird stuff, title company will pick that up because we close everything through title. So our process, first off, do we have the right person that we're talking to that's actually on title? You'll see a lot of times when you get deals that get sent to you, and maybe they have the same last name, like a cousin or relative, or flat out, sometimes we get people that aren't even related and try to sell us a property they don't own. So do we have the right person who's on title? I factor in comps into due diligence, right? So like going through, making sure that the comps make sense. Access. So does it have legal access? If it does have legal access, does it have physical access? Like how realistic is it to actually get on the property? Flood zones, topography, back taxes, and we'll do like just high level probing on utilities, like what's available, what's around. That's it, right? We don't really have to go, and that's the beauty of land is like you don't have to go a mile deep. Now for like the weird stuff, HOA liens and all that jazz, just let the title company find that, right? When we get the title report, we'll go through it, and anything that's a major red flag, we'll go and find. All right, Justin says, when targeting a market for a mailer, do you typically hone down to a specific subdivision by zip code or by lot size, or does it just depend on each particular market? Good question, Justin. Okay, so yes, it does depend on markets, right? Like markets, no market is the same. And I think first off, when we talk about markets in the land space, so many people assume, oh, market means county. Not so much, right? I think that kind of old adage is something that we probably need to work out of our mind, right? Because I think too many land investors aren't seeing the results that they want to see because they don't know how to price and pick a market that actually has demand, but more importantly, how to price it. And the reason they can't price it is because they're taking too big of a swath of land. And the reason they're taking too big of a swath of land is because they think a market is a county. Counties are ginormous. There's a huge range in topography and price point and all that jazz. So our entire framework in the LIA program is what we call micro mailers, right? We take areas that are very binary, like the pricing is homogenous, the land's homogenous, and we just price those, right? Like I was talking about earlier, it's that ratio of inputs to outputs. I like mailers that don't take much time, but net us really consistent and big results in the back end. Where I see a lot of new land investors trying to take on these impossible markets, like it's got a lake in the middle and it's got like a big mountain on the backside. It's like, how the heck are you going to price that? So I think it's important to always be thinking about it from that framework. Now, Justin, some mailers that we do are going to be a third, a quarter, a fifth of an entire county because the land is so homogenous. There's not much variation there. But I would say for the most part, our mailers are going to be relatively subdivision specific. Now, some of those will be a real subdivision that have like an HOA or a POA, or some of them will just be things that look like subdivisions, but there might be actual different subdivisions, but they could just be like, okay, out here, it's all 2 to 5 acres. It's very similar topography. It's a very similar landscape. Maybe they're different subdivisions, but if the pricing is homogenous, we don't really care. Now, do we go zip code? Nope. Don't look at zip code. There's a lot of different things you can use to hone in on a specific area. My favorite strategy is we look at it in terms of a funnel. So top of funnel, we start with a state, and picking a state is like throwing a dart at a dartboard. There is no quantitative way to do that, right? Just pick any state. Every state has markets. So we pick a state, then we go and look at that state and say, okay, cool. Which counties are selling the most properties or have the most under contract currently? So we go and find the demand. Cool. We just find what that county is. We go look at that county on a tool like Redfin. On that tool, it'll show us boom, 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 boom. We see all these clusters of sales. Look at like the 1 month, the 3 month, the fill in the blank. And then we'll start to find little pockets within there. And some of those are subdivisions. Some of those are areas that just have homogenous pricing that are similar. And then in those little areas, we start to look at what we call sell-through rate. So how much supply is there versus how much demand is there, how many properties are selling every month. And we've got internal rules that we use to say, cool, this kind of meets our criteria. Again, in this business, there's always exceptions to the rule. So it's not perfect. It's just kind of a hard, fast rule that we use. And then, that's how we find markets, right? So a lot of it is a blend of kind of visualization of comps. But the top of the funnel is finding where the most demand is through sold and under contract comps. So, and there's a lot of different things you can use. You could use the APN to target an area. You could use zip codes. You could use municipality. Like there's a lot of different things you could use. But I like just saying, where's the demand at, right? That's the easiest for me. And then inside like pulling the data, we typically use like a polygon tool or we'll use a subdivision search filter. Sumner, just wanted to add something. The main reason I think in terms of market value is to be confident I can secure funding when space out. So just wanted to add something. The main reason I think in terms of market value is to be confident I can secure. Thanks for returning. Yeah, I think that's fine. I think if you're using other people's capital, for sure. I think that's a fine kind of line of logic. Now, if we're looking at double closes or what have you, and again, like for deal funders, the more deal funders that I've used, what I've seen to be more important is not the ROI in terms of a percentage, but for a lot of deal funders, it's the deal velocity and how much capital they can exercise. I think any deal funder on this call or out there in most situations would rather take a deal that makes them 70% ROI, but they can exercise 200 grand, and let's say that deal sells in 30 days, than a deal where they can exercise 30 grand, but they're making a 300% ROI, but it takes them 3 months. I think almost every deal funder would take that first deal. And so I wouldn't just be thinking in terms of market value. I'd be thinking about the speed that the deal is going to turn over, how much capital can be exercised in one go. But for double closings in particular, that goes out the window. And so at that point, it really is just thinking about what's my bare minimum I'm willing to accept net on a deal, because there's no way around it. It's going to take a shit ton of time to do double closes. We'd love to hear about your subdivide situation and troubles, as this business isn't all easy. I learned that most of my failures, for sure. When do you know if a property is going to be subdivided? Okay, hold on. Give me 1 sec, guys. All right. So Dennis, I'm going to answer your question first, and then Alex, I will answer yours. Justin, of course. All right. So when do I know a deal is going to be subdivided? Nowadays, I'm a little more tuned in than I once was. Back in the day, there's a lot of stuff that just slipped through my radar. So for me, it starts with specific states where I know the subdivision regulations. So if I get a deal that might have subdivide potential, but it's in California or Oregon, like I'm probably just I'm just not even interested. I just know it's too much legwork in some of those states. So I'm tuned into the states that I like for subdivides, and that's usually because they have nice exemptions for making subdivisions relatively easy if you check off those boxes for exemptions. So right now, Texas, Oklahoma, I like those states. I'm open to Arizona. I'm open to Colorado. We've got one in Colorado that we're working on currently. So that's the first step. Do I like the state for subdivided regulations? The next step is road frontage. No ifs, ands, or buts. If it doesn't have road frontage, I'm out. Not even remotely interested. Ideally, road frontage that runs like the full length of, like, the perfect subdivision is a rectangle running with road frontage along it, or maybe on like multiple sides of it. It's the best case scenario. And so, Alex, to answer your question about my subdivided troubles, this kind of ties into that road frontage. Is that we've got a deal in Texas, like I was telling you guys about, 200 acres by San Antonio, beautiful area, lots of demand. Buying it at $47.50 an acre, it's worth $12,000 to $15,000 an acre if we sell it off into 10-acre lots. It's got a well on it. It's got like a quarter of a road running back through the property. It is like like the opposite of what you'd want. Like, it's not skinny per se, but it's pretty long. And it's not super duper wide. It's not skinny. It's definitely not a bad lot, but we would have to cut in a road to get to the 10-acre lots. You'd have to make the skinniest little flagpole lots if you just cut it vertically. So it's got a well on it. It's got a power pole to the middle of it. It's got part of a decent dirt road. And it's got like a cabin shed deal. I think it's livable. I'm not positive. So the math looks great. Buying at $950,000. We've been working with a bank out there. They've kind of been more difficult than we first realized. They said, first, 75% loan to value for sure all day. You guys look great on paper and the deal looks amazing. So we're like, oh, boo, yeah, okay, we're going to be putting down less than $250,000 for the down payment. I knew we were going to have to cut in a gravel road, so I figured, I don't know, $10 a linear foot, something like that. I think it's usually like $1 to $3 per square foot. I don't know, somewhere in that range for a gravel road. So I was thinking it's going to cost us $30,000 to cut in this gravel road. That's really our main expense here. Gravel road surveys, like, there's not too much that we're going to have to go through in terms of additional costs. So buy for $950,000 with the bank fees and all that jazz. We're probably going to be at $1 million to $1.02 million or something like that. Not a whole lot of additional kind of value add cost here. So now the bank has said, hey, you know what? We're actually only going to give you 50% because you guys haven't submitted your 2022. You haven't filed taxes yet. I always get an extension on my taxes so I can kind of keep on snowballing that capital in my business. So I'm like, okay, that's really odd. So we found another deal funder. So we've got like the capital roughly figured out in this deal, right? Okay, cool. We've overcome that. That's been like the last few weeks of getting over that hurdle. And the next thing that we've run into is we're diving deeper into the regulations out there for subdivisions. Okay, these regulations, first off, make no sense because it says if you're checking off the exemptions and you're outside of a municipality, that none of this stuff applies. But if you are in a municipality, it looks like it's California, right? You got to cut in paved roads there's like all these culverts and setbacks and flood zone things and just so much. And you got to hire an engineer. Like there's a lot you got to go through. And for you guys that aren't familiar, like a paved road might be $85 a linear foot. And we're talking about probably, I don't know, a mile of road, something close to that. So it's a long freaking road. So we've been calling up the county. We can't really get a firm answer. And they're like, no. You guys are outside of city limits, but this still applies to this property. So we're in like this weird gray zone. Like we've overcome the hurdle of the fundraising. I'm not a master at reading these subdivision regulations. So from my checking off, I'm like, this looks pretty simple. It looks like we check all the exemptions. There's a bunch of other mumbo jumbo about roads and flood zones and wells and all this stuff. But I'm like, none of this applies to us. Sure enough, it might apply to us. So if it does apply to us, either the deal is dead or we cut it up and make sure each lot has road frontage, right? And again, Dennis, this is why road frontage is paramount to us. So what we could do, instead of 20 10-acre lots, we could do 3 lots. Now, there's still enough value in this deal that I think we could make close to double our money with 3 lots. And if we're using outside capital like bank financing or cash on cash return is crazy. So even if we don't make a full double, it's still really powerful. So we could do 3 lots. So if you're looking at the property from the road, 2 lots that are smaller that have road frontage, and then 1 lot that's shaped like a hatchet. So imagine a skinny flagpole, and then it opens up in the back. And that would actually be the property that already has that road going on it, luckily. And then that would have the structure on it as well. So I'm like, the back property would probably be over 100 acres. I think that back property could sell for $800K, $700K. There's comps out there that support that. And then the other 2 lots, we could probably make, I don't know, it's hard to say. If they're 50 acres each, we could probably sell each one for $400K. It's like make 1.8 or no, 1.6, buy it for $950. That's not a great deal for paying for the full $950, but if we're putting 25% down or something like that, cash on cash return is pretty good. That's the trouble with these deals, though, is they're effing scary. There's a lot of capital at play here, and there's what I call third party risk, right? When I go and do my bread and butter cash flip, there's no third party risk. I own the property, I get on title. The only third party risk is the title company screws the deal, but that's rare. But they slow down the deal. They do silly things. But that's the only third-party risk. With these subdivisions, the third-party risk is the bank. Third-party risk is the county. That's putting a lot of eggs in someone else's basket, and I'm a control freak. Like that scares me, right? So I think it's just a scary game. It's a whole different game. I think a lot of people look at subdivisions as like, dude, this is so easy. Grab a lot, chop it up, make a bunch of money. Not quite. There's a lot more that goes into it. Alex, for sure. I didn't know you were in Maui, man. Small world. I'm actually running a marathon in Maui, April 23rd. My birthday is April 27th. So I'll be spending my birthday out there. I'll be out there until May. So if you want to link up, just let me know. Always down. I have this vision of like doing a land investing road trip and traveling the country and hanging out with land investors in person. So that's my dream. Alex, send me an email, Sumner. I'll put it in the chat, sumner@landinvestor.co. All right. So what else we got? RB, I don't have anything against building a team. In fact, I'd like to eventually have a team, but right now, my sister's starting up. My business model is making about 15. Okay. RB, how many deals are you doing currently? What kind of volume you guys are doing? I think here's the thing, guys. This is more, I guess, woo-woo or mindset or higher level, but like the deeper I've gotten into my entrepreneurial journey, and I've been building businesses since I was 18. Like this has been my life forever. And I grew up single mom, dirt broke, like money was paramount. And I made it like an unhealthy obsession to make money. But because I came from this lack, from this scarcity, everything was right now. I want to make $1 million this year. I want to make the big money now. It's like what I've learned is if you can extend your time horizon, you make better decisions, right? Like these right here, right now, cash in my pocket kind of decision making, I think leads us to make decisions that aren't long-term. It's like the more money I've made, the more I realize I'm thinking in decades, right? I don't give a shit what I make this year, roughly. I mean, I still care. But what can Sumner do in 10, 20, 30, 40 years? That's more important to me. And so, RB, dude, if you're making 15 to 20K per deal, dude, that's amazing. Get rid of that like, I need to make $1 million mindset or goal, focus on the controllables, right? Focus on how much mail can I send? Can I build operational excellence? Can I really divvy up the roles between my sister and I? Can we have a clear breakdown of our roles in this business? Can I come in and execute every day, not for the result, but just for the process, right? For operational, I always think operational excellence, and the good stuff will come from that. And so I talking to 50, 60 land investors a month that are joining the LIA program or looking to join the LIA program, I hear that a lot. It's like, I need this to save me now. I need to make this money now. I need to hit this goal now. I don't know. I think like my decisions have become better when I've zoomed out. And so it's just a kind of more of a mindset recommendation. If we can think longer term, we make better decisions, in my opinion. And I'm like, when I look at the hierarchy of building a business, you get to a point where your only responsibility is decision making. When you get out of the trenches and you're not the practitioner doing everything, your job is to make decisions. And we get paid on the quality of the decisions that we make, right? And so if I'm making here and now decisions to get paid now, it's like, I just think the quality of those decisions isn't as good. Max, do you pre-market and collect LOIs from buyers for the 10-acre tracts you're planning on dividing the 200? Yeah, that's a good question, Max. So I certainly would. I don't collect LOI. I mean, I've never collected an LOI for a property that we're pre-marketing, but I will collect holding deposits, which is similar, right? It shows intent. So we pre-market every property. Once we get the title report and everything checks out with the due diligence, we go and send it on off for pre-marketing. We don't put it on the MLS, obviously. But yeah, we pre-market everything. Best case scenario, you sell it while it's in title or a little bit thereafter. We don't sign a purchase agreement right then and there because we're not on title yet. We just collect a holding deposit. So we do $500 down and then $249 for the document prep fee. So $749 secures the property, $249 is to draft the documents, $500 is for the holding deposit. That shows intent. We explain it to the new buyer. Like, I think you just got to disclose everything. Now, in a case like this, certainly interesting, right? I'm not far along enough in the deal to do it yet. So we actually have two guys in the program, Mayor, who I mentioned earlier. We've got another guy, Cole. So Cole's first deal inside the LIA program, his first deal ever, was a $550,000 Subdivide deal out in Texas. He partnered up with Mayor on that. They did a double close Subdivide. And what they did is before subdividing it, they went and pre-marketed the lots and started selling off the lots. And they're like, oh, cool. It's worth investing and surveying it and getting the Subdivide done. So I think that's wise. I've never done it on a Subdivide, but we do it on tons of pretty much every single deal that we do. Now, there's some deals that are so good, right? So good that I don't want to run the risk of having the deal fall out while I'm in title. And so if that's the case, we won't market it until we actually hold title. But yeah, Max, I would totally do that. I wouldn't do it on the Subdivide, though, until it's a surefire thing that I can actually subdivide it into 10-acre lots. Because right now, even if we're on title, I still have reservations about, can I even pull this off? Because I might have to go drop multiple six figures to pave a road in. That's pretty crazy. I don't know if I want to do that. Dennis, what's the min size for subdivision lots? So there is no minimum, right? So that's why it's state specific. So that's why you got to first figure out what state do I want to work in. And that starts by going and reading the subdivide regulations in different counties and different states. Most states are going to have kind of like a flat, just like across the board standard. And then counties can have specific requirements. And then on top of that, cities can have specific requirements as well. Pretty much won't touch anything that's within city limits. So you first got to figure out what states you're working in. And by understanding the regulations in those states, you'll then be like, okay, cool. These are the minimums that I have to work with. So for us right now in Texas or Oklahoma, 20 acres is the minimum because we want to leverage that 10-acre exemption. A general rule of thumb, though, small subdivides like 1 acre lots, quarter acre, half acre lot, pretty much in every state that I'm aware of, those are going to carry a lot more red tape, a lot more work. Now, you're going to get more on a per acre basis for value. So you're going to have an extreme return. But those deals can take years to put together. So I'm not interested in anything like that as it stands, unless it's got city utilities. So if it's got city utilities, that's kind of a backdoor exemption that you can get through to do smaller subdivides. But for the most part, I'm looking at 20 acres and above as kind of my bare minimum. Now, in other states, that's different, right? So like in Arizona, for example, I guess it would probably come down to 10 acres or to 20. It'd probably be about the same. And again, that also kind of feeds into our business. Like our business is rural rec. That's really what we focus on. So typically we want to be selling stuff off that's kind of in that rural recreational bracket or rural infill. All right. Any more questions y'all got for me that you guys want to go through? I'm going to talk to you guys about this double close deal. I totally spaced on talking about that. So we got this really cool double close deal. It's out in Tennessee. It's 35 acres. We got it under contract at 60. Now, this is a weird deal because it doesn't have road access. And so if it had road access, this deal is worth $250 all day long. This is the value, I think, of being transparent, right? Dennis, I'll answer what was my worst deal in a second. I think that's the value of being transparent. And so with the seller, we're like, hey, we want to do this deal, but we're going to do it on a double close. And what we knew is the seller's property butts up to this lot. His lot backs up to this property. And so we're like, hey, we will pay you the 60. We originally offered him something pathetic, like 30 or 40 grand. We'll give you the 60 that you want, but you got to give us a deeded easement through your property to this property. And by being transparent, he said, sure. Right. And if we weren't transparent in the process, there's no shot we would have been able to get this deal because we got to lean on him to give us the easement. And sure enough, he's like, cool, I'll give you guys the easement. So he's recording the easement with the county. With that easement, I think the deal is worth 140, 150. It's nice land. It's mountainous. It's got kind of wild topography, but we have access through his lot. It's not physical access, it's not a road cut in yet, but we'll have deeded access that will grant to any owner for the whole life cycle duration of that property, right? So forever. So that's a cool double close deal. I think that just kind of hits on the value of being transparent with sellers, right? I think a lot of people will be like, ooh, the seller lives next to the property. There's no way they would ask for that. Sometimes it just doesn't hurt to ask. I don't know why he needs the 60K, but he's dead set on that number. He's got something in his life as to why he needs that. Dennis, what was my worst deal? I got a couple. I got a lot, actually. So I've always had the mindset of like ready, fire, aim, right? Like I just take action and I'm messy. I am so messy. That's how every business in my life has started is I will run a pilot test. I'll get proof of concept, then I'll go all in. But that pilot test is disgusting. Like it is messy, sloppy, bad. So when I first started, dude, I didn't know how to even look at a property on a map. I didn't even really know what a deed was. I knew nothing about real estate. But what I knew is I could buy an asset at a discount. Like there's money to be made there. And so I got into the land in a very weird fashion. I was trying to wholesale houses, found a tax delinquent list in Elko, Nevada, Elko County, and sent some mail, started talking to sellers. I didn't get a deal there. I got really close to a deal, ended up getting a deal in Pahrump, just west of Las Vegas. And I was off to the races, right? And so when I first started, I was buying deals that didn't have legal access. I was buying deals that had the worst topography you could possibly imagine, like culverts, gullies, ditches, valleys, horrible properties, most of them without legal access. My first year, I did 59 deals or 60 deals. And I would say probably half of those didn't have legal access, which is hilarious looking back. And I made money on just about every single deal. I did it by selling them ultra cheap. I mean, some deals I'd make $1,000 on, offering owner finance terms and waiting. Like some of those deals took me a year to sell. So you could kind of qualify all those deals as being bad. I had a recent deal last year in Texas that had this nasty pipeline running through it that I didn't fully factor in. That ended up really hurting the deal. We bought it for 45. It looked like it was going to sell for like 150. It turns out it had this horrible pipeline. It was big, it was ugly. So we ended up selling that for 120 on owner financing terms, but we got a tiny down payment, right? But we get $1,700 a month in payments from that. So that one is a slow, like 2-year payback period. It's a bad deal. That was like my only way to exit. And I don't need the money, right? So I'm cool. Like I could have sold it at 45 or 50 for cash, but I don't need the money, and I could always sell the note if I wanted to liquidate it. So that was a bad deal. That was just poor due diligence on my part. I just didn't really understand the impact of something like that. Like it was an 11-acre property. I knew there was a pipeline on it. I just didn't figure it really mattered, and I couldn't see it in any of the pictures. Apparently that's pretty bad. Also had a few deals. These weren't quote unquote bad deals by any means, but I had 3 deals in Arizona last year out by Phoenix, 1 to 2 acre lots, rural infill. I think the trouble here is I got outside of my wheelhouse, right? Like I'm the rural recreational guy. And not to say you can't overlap, like you can do a little bit of rural infill, like they're close enough, they're cousins, right? They're very similar. But I got outside of my wheelhouse. I just didn't fully understand this market. I didn't understand where we were at in the market cycle and how impacted these lots would be. And so we bought these 3 deals, each of them at about 45 to 55. It looked like those deals were going to sell for 100 plus cash, super hot market. Bought those in July or August. And right at that time, the market started to sour. All the new home builders put a pause on new development there. The buyers that we were getting couldn't get lending from the banks anymore because they weren't comfortable with it. And so those have been tough deals to move. We just sold one last week or 2 weeks ago, and we bought it for 51 and we sold it for 65, I think. So pretty shitty deal, right? So yeah, I still do bad deals. Like it still happens. I'd say every year I do 1 to 3 bad deals. That seems pretty typical. Now, what's beautiful is about this business, bad deals aren't really bad deals. Like, okay, we made, 14 grand on that deal. Even from a percentage standpoint, for most people, that's a crazy investment. But we're so jaded in this business, 100%, 200%, 300% returns, that kind of gets us jaded, right? And so if it's not as good as that, it looks terrible because everything is relative. So those were bad deals. What else? What other bad deals have I had? I've had deals with like squatters on them. I had an owner finance deal in Colorado that was in the subdivision, and this guy like pulled out a bunch of junk and started like hoarding stuff on it. I was getting calls from the county, and like that was a bad deal. So yeah, I've had a few. Which state's easy to subdivide, like Texas style? Yeah, so I answered that question earlier at the beginning of the video. If you want to go through and watch that once it's live, I'm just focusing on Texas currently. That's my only main focus. We've got a subdivide in Colorado that we're doing. We've looked at subdivides in Arizona, but I just keep it really simple, right? There's a lot to learn on a state-by-state basis for subdivision regulation. So I'm just looking at Texas. Any other questions y'all got for me that you guys want to work through? Anything? For you guys that are new here too, if you guys are not inside of our Discord, I would recommend joining at the link that I'm going to put into the chat. If you guys want to have access to me and the LIA team and all the other members and be in a group of full-time land investors, I'm going to put that in the chat if you guys want to join. Max, we put into contract release of lien and a marketable title with 100% of proceeds going to the owner as we subdivide tracts. Oh, that's interesting. The contract release of lien and a marketable title with 100% proceeds. Huh. Yeah, Max, how many subdivides have you done? That's super fascinating. Are you doing double close subdivides or like owner financing subdivides or what's the play there? I think this is how a lot of people do business, right? Like at a bigger scale. That's what I was talking about earlier with option contracts and development. I think it's a cool strategy that you can execute on for entitlements or subdivides. So yeah, we'd like to know more. So you just put down escrow and use buyer's money. Oh, wow. Max, where are you doing subdivides at? That is interesting. I'm going to close this off here soon. We've been running up on an hour and I'm starving. I'm going to go for a run in a little bit. Depends. We're doing 350 outside of Dallas. We'll be double closing with our end. Wow, dude, that's super cool. San Antonio and Dallas. Max, yeah, I've got a deal outside of San Antonio. This is the one I was referencing. It's in Wilson County, 200 acres, about 45 minutes or so from San Antonio. It's an interesting deal. But yeah, man, that's super cool. It's a world that I'm stepping deeper into, right? I've really been focusing on it for the last 6 months. And I honestly feel like a beginner all over again. Like I feel like I'm starting from ground zero. Less risk and don't have to use bank money. Max, have you ever run into, I don't know where this is true or if it's true, I think it is. Aren't there some counties, for example, in Texas where to subdivide, you have to be on title? Is that something you've ever run into? I think it's few and far between. Just sell property and take a fee if a huge property. Yeah, I'm not familiar with novation agreements. And maybe Dennis could speak on that since he's kind of in or Rob, since you guys are in the creative finance side of things. But yeah, I don't see there's any reason as to why you couldn't do a novation agreement on a big property and take a fee. All right, guys, if that is all, we'll end it here. This was fun. If you guys like this, certainly something that we'll do again in the future. I love chatting with y'all and shooting the breeze. And the beautiful thing is I learn when I do this, right? Like interfacing with everyone here is awesome. Like, and when the reason that I created the LIA program was 2 reasons. One, I wanted a community. Like I was a lone wolf And this business is kind of a weird path to walk. There's not many people that are in the same space, not many people that can relate to the woes, the ups, the downs of this business. So the community aspect is awesome. So I love hanging out with you guys. The other reason, which I haven't really shared too publicly, but about a year and a half ago, I've been coaching for about 2.5 years, but on a very one-to-one basis. But about a year and a half ago, I ran into a fulfillment crisis in my life. And that's one thing you'll learn about this land business. It's cool because it's transactional. You can scale up quick. Cash flow is insane. But you're not really doing much good to the world, right? And so I ran into like, what the hell am I doing in my life? Am I just flipping dirt to keep on paying myself? And is that it? Like if I died tomorrow, is that my legacy, or is that all I provided to the world? And so, yeah, this has been a really fun journey. So I appreciate you guys stopping by. If you guys are curious about the LIA program and want to learn more, I'm going to put the link in the description. You guys can hop on a call with my team and I and see how the LIA program can help get you guys scaled up in 2023. I'll put that in the chat for you guys if you want to book a strategy call. On that strategy call, we go through and build you out a roadmap for your land business and break down exactly where you're at, where you're looking to go. What's beautiful about the program is we have nearly 100 members inside the group coaching program currently. And so we've got intel on everyone's businesses, right? We understand the KPIs for pretty much everyone's business in terms of how many mailers we have to send to get a deal. What are our average gross per deal? What are operating margins for a business like this? So it's awesome. So we'll build you out a roadmap. It's not a sales call. I don't really believe in that. Dennis, I appreciate it, brother. And for you guys that don't know, starting next week on Thursday, every second and fourth Thursday of the month, Dennis is coming in and doing sales training for the LIA Group. We'll go through and call sellers in real time on that call, work through deals, listen to call recordings. It was what we've seen as the issue for most land investors. They're either good at the data side, terrible at the sales, or bad at the data and great at the sales. And so this is just in an effort to kind of keep on working through and removing the friction for the LIA members. And so Dennis is going to be running point on those sales training calls Thursday at 4 p.m. PST, second and fourth Thursday of every month. It's going to be badass. Dennis is a sales wizard and a real estate guru. Dennis is cool because that guy's got his hands in a bunch of different buckets in the real estate space. Bill, thank you, brother. All right. I will see everyone here soon. Thanks for stopping by, y'all. Much love. Everyone have a great Friday. Enjoy your weekend. Be safe out there. Buy some land. I'll see you guys soon.